Hello, hello, hello. Good morning, good morning. Good morning. Let's check and make sure the stream sounds good. Boop. Hello, hello, hello. Hello, words. Words are interesting. Hello. There we go. Good on that end. All right. December 9th. Year is winding down. Surgery went well yesterday. A little sore, but it's all good. Oh, hope everybody is doing well. Let me make a community tab post. Very sore this morning. But it's all good. It is all good. Whew. Look at some news articles here. Hang out for a little bit. Have us a good old fun morning. Oh, this seems interesting. 12 companies that had IPOs in 1992. I was curious. Starbucks. Starbucks came out in 1992 on the stock market. Okay. Interesting. That'd have been one that'd been nice to get into and let it compound over that time. Starbucks is one I like. I really like that company. Buckle. Kohl's. Scott's Miracle-Gro. Oof. That's unfortunate. Since IPO, things only up 36%. Ow. Ow, ow, ow. Let's look at that one. LGND. Oh, that's terrible. I mean, it did have a little spikeroo up here. Big drop and then spike back up. Gosh, can you imagine buying something 31 years ago and only being up 34% on your money? Oh my God, I'd be mad. But I mean, there's a lot of things. There's some other stocks that have very similar situations. One of them actually being Intel. It never got back to its highs. It got close, but it never got back to where it was during the .com bubble. If you would have bought at the top, rough times. Rough times indeed. I give Intel like some hate, but they're turning things around. They really are. They've had a really good year so far. Up almost 60%. I mean, they've they're doing what they got to do. Quarterly revenue's been growing, EBITDA's growing, free cash flow's starting to get more under control. Their debt is not hideous. CapEx isn't terrible. Ow. Oh, yawning hurts. Anything hurts right now. Existing is painful. Oh. That's the thing with Apple is like half the analysts think that they're going to go nowhere in growth. The other half are convinced that it's still going to be the greatest thing in the world. It's so hard to get a read on how analysts view this company. So hard to get an accurate read on it. And I mean, their expansion plan into India definitely will help with increasing their revenue and stuff. Apple's had a couple of really rough quarters. Yeah, over the last 3 quarters, it looks like. Yeah, their year-over-year revenue has been down. I mean, it's not the end of the world, but I mean, it is something to keep an eye on. One magnificent stock to buy that is near its 52-week low. Oh, PayPal. This is another company that's just been dragged through the mud. A lot of people believe in it. Oh, excuse me. A lot of people do believe in it, but like they gotta do a lot to turn this thing around. They gotta do a whole lot over there, PayPal. I mean, they are growing. They got more cash and debt on hand. Massive news. Amazon. Oh, Amazon dropped Venmo. Why? That's not good. Hmm. I wonder why they did that. I don't know. I try to not invest in speculation. I try not to invest in just any old thing. I try to be smart with my picks. I know Deere and Company's been down. It looks like Starbucks is dropping too. I like these two a lot, to be honest. And Starbucks has got some growth going on. It's very nice. Positive free cash flow. EPS is growing. They haven't started buying back shares again. That'd be nice when they start doing that. They just keep having all this like negative news pop up, and it's killing the company. Like this thing goes up and oh, I'm so sorry, guys. I'm so tired. I've not been able to really rest well the last couple days. And surgery, it's about to kill me. But Starbucks would be so great if it could just figure out its employee situation, because it's pretty volatile, up and downs with all this union talk and striking and stuff. I just don't know what exactly they can do going forward to help mitigate that. And it's a great company. I love their stuff. There's one a town over from me that it's hard to not stop at one when you see one. 3 safe dividends with growing payouts that can help you rest easy at night. Let's see what this has got on it. Caterpillar, American Water Works, and Starbucks. Okay. Caterpillar, good company, really, really high priced right now. My personal opinion, 260 area is a bit rich. American Water Works, AWK. There's something that I really don't like about this stock. We'll talk about that in a second. And Starbucks, I like Starbucks. Let's take a look at AWK. It is one of those, if you don't dive deeper into it, you might get caught buying something you probably don't want to hold. Not financial advice. Personal opinion. So you're looking at these metrics, you're like, oh, it's over 2%. Yeah, payout ratio is 56%. Not too bad. Revenue for utility, slow and steady. Not too bad. You have Maine in your portfolio? No, I do not have Maine in my portfolio. Maine is a really great BDC, though, and like around $38 is my personal. This is a great value for it because that dividend and reliability behind it is really nuts. Great, it's a great, very well ran BDC. The thing with these utility companies, though, that kills me. Look at that negative cash flow. Oh my god. It's growing. So they're losing more and more free cash flow while their debt is growing. It just red flags for me. It's just no bueno. And they're issuing more shares over time. Again, and their capex is increasing. I don't know. This is a zombie company in my eyes. It needs debt to survive. It's the reason I've never really been a fan of a lot of utilities. Are in the same boat though. But no, like Maine's absolutely a great BDC, especially for those who want like income now. And they issue out a lot of special dividends. I mean, I like them. They've given fairly good returns in the market over the last 10 years, I believe. Let's go ahead and take a look at that. Drip calculator. Looking at Maine. Compare it to the S&P. I mean, it's not bad at all. Maine over the last 10 years would have been giving you a 11.28% annual return with drip on. It's pretty good. Seems like a special divvy every other. I mean, yeah, they issue out special dividends like crazy. You see all these little bitty boops in here? All those are special dividends, and then you see these spikes. I believe these are also special dividends. And they've accelerated here the last couple of years at how often they give out a special dividend. Which, I mean, it's a good thing. It means they got more cash than what they know what to do with, so they return it to the shareholder. So absolutely would not complain about that at all. Great company, though. Very great company. How are you doing this morning, though? I appreciate you dropping by and hanging out with me. Deere is on my watch list so hard right now, though. Like straight up, this thing has dropped back down to a price I like, and their automated tractors, like their farmerless driving tractors, is just so cool. And I use the tractor at work a lot, quite often actually. They are fun to drive. Yeah, this is one that's on my radar. I got a lot of thinking to do with my portfolio going forward for 2024. There's there's definitely gonna be some changes. Um, Probably gonna be some changes here too on the old channel Reno going forward. I'm hoping to be able to put out a little bit better content, get some growth going. Cat versus deer versus CMI. What is your take? Right now, I love deer. I love deer at its current valuation a lot. Caterpillar, I think it's a little rich. This thing was up in the 280s. Let's see here. Last 5 years. Oh, that's pretty good cash flow growth. I like Cat definitely on like a pullback a little bit. I mean, it doesn't have a bad adjusted free cash flow yield. Usually, you want to find companies 4 or 5% plus, and this is setting at 6.66, which is telling me it's not a terrible valuation. The revenue's kind of flattish. And what was your other one? CMI? I think that's Cummins, isn't it? Yeah, it's Cummins. Their debt situation's not too bad. Not bad at all, honestly. They're not super pricey. Got a good adjusted free cash flow. Near that 52-week low. I mean, I like, in this order, probably Deere, Cummins, Cat. If Cat was to pull back anymore, probably they would jump a position or two. The thing I like about Cummins is it looks like they've got their free cash flow situation back on hand. They had a big quarter last quarter, which is very nice, and good consistent dividend growth, 7-10% over the last 10 years. Just trucking right along. Like to see that. Their financial sheet's pretty good. Their capex has grown a little bit, but compared to what it's been over the last 10 years, I don't think it's anything alarming. So honestly, I mean, they're all three pretty good, pretty solid companies. Let's see how they stack up here in the dividend calculator. I'm looking to start one of them for a new position. Oh, okay. I mean, you couldn't really go wrong with either. And I mean, not financial advice, not telling you what to do. But I just think Deere is at such a great value right now. It looks like Cummins has been underperforming the market for a while. That is with dividends reinvested, and even without it, only about an 8% return over the last 10 years. My personal opinion, just based off of what I've seen in the dividend calculator, and just as a whole, like I would take a harder look at Deere or Caterpillar, definitely. And I'm not telling you what to throw your money into. Just that's what I would do personally. I just really like Deere and Company. They've had such a good year, and there's like a small concern that outlook disappoints, equipment demand slows. This is the only thing that's kind of got me like wanting to wait.
Fort Miami is
play a video. Is they're expecting a little bit slower sales next year, which obviously will impact their revenue, impact their free cash flow. They did just increase their dividend again by about 9%, I believe. So, I mean, that's always good. I just wish that this company had a little bit more consistency. If you look here at the revenue, it's growing now, but it's been kind of flattish up to that point. Their free cash flow is all over the place. What's not showing for me? Well, as you can see back here, they have some negative years, some really positive years. And another thing is, if you're into dividend investing pretty heavily, there's been times where they've paused their dividend, and I'm kind of like, why? What are you doing? I got time to think about it because it's going to be in my Roth, and I'm maxed out for 2023. Okay, well, that's awesome. I'm hoping one day I can get to that point where I can max mine out. Mine just has SCHG in it. That's the only thing in my Roth, and I just DCA into it every paycheck, just a little bit here and there. I think they upped the amount that you're going to be able to put in next year. Oh, I'm so sore. Ugh, it's terrible. I don't know what company I really do like. Oh, AutoZone. How about ENB? That's Enbridge. I like Enbridge. I like Enbridge a lot. It's got a great dividend yield, 7.73%. They are trending in the right direction with their free cash flow, as you see here. Last couple years, nice positive free cash flow. The dividend's a little bit everywhere. It's kind of been flat-ish for the last 2 years, but it's they're very diversified. It's not just oil. It's not just, energy related things. They've got some natural gas lines. I think they're looking into renewable energy as well. They are doing a great job at diversifying their portfolio, and I like them a lot going forward. I'm curious, Motley Fool, you have 2 high yield energy stocks to buy, hand over fist, and one to avoid. I wonder what their one to avoid is. Yeah, energy, this is their one to buy. I think a Devon is the one to avoid. Enbridge is focused on reliable growth, midstream sector. Enbridge has been investing in natural gas. Great, please do that more. Limiting its investment in oil pipeline side of the business. Great. Building a clean energy portfolio. Great. I don't know. I like them. Slow and boring investment. They've been increasing their dividend the last 28 years. I mean, I like Enbridge. I mean, I won't lie about it. I'm a fan of them going into the clean energy a lot more and looking into that sector. That's going to take off a lot more as well once interest rates start going down. A lot of your clean energy stocks are just destroyed this year, just beaten up. Next era would be the big one that comes to mind. They've had a super rough year, down 28%. This is one I got lucky on, and I got out in the nick of time. But I mean, if you believe in clean energy and everything going forward, Enbridge, I think, is going to slowly, over time, make that transition, and they're not going to do it in a hurry. It's going to be a slow burn, and it's a smart way to do it because you jump in feet first into clean energy because it's so expensive. Do you have any gas and oil? I don't have any gas or oil in my portfolio personally. This is what we're rocking out. I had 2 growth stocks, but I'm probably going to sell those on Monday. They're so small in comparison to everything else I hold. And my one holding, Ulta, I got in a little bitty position in the 390s, and now it's close to $500. And I don't know if I'm gonna be able to buy any more of it, and I don't want to have just like a 2% position sitting there. So I'm probably just gonna sell out of that and my Celsius, and just keep my nice little condensed portfolio going here. Uh, but yeah, this is everything I hold. Hershey's obviously the one that hurts the most, as you see here. 200-day moving average is down 19%. They can't catch a break. I do have some railroad. I have some CNI. I love CNI. I got into CNI at a great price point. I got in at 104. Literally, this is the one instance where I timed the bottom perfectly. Right there. The main bottom is where I bought in. I love this company though. And I like the railroad industry as a whole, and it's actually been something I've been thinking about buying more of. Not necessarily CNI, because it's not at my price point. You need some railroads. I mean, one to think about if you are definitely shopping for a railroad company. I personally think it's still at a good price. Canadian Pacific Railway, they're doing a merger right now with Kansas City, and what that's going to do is open up more revenue stream for them, and they've got great guidance going forward. I'm probably going to actually add this to the portfolio. I just like it so much. In their future plans, they're wanting to lower their leverage, pay off some of their debt, and keep their leverage lower going forward. And they had to issue out shares and stuff for that merger. But once they start buying back shares and stuff again, I think this one's going to take off. I have high hopes for this one going forward. Again, it's probably going to be something I'm going to look into. There's a couple of other ones out there, but they're a little bit pricier. Another one to maybe look into if you can catch it at the right price. CSX. This was another one I was looking at. But I was looking at it back here below 30. It's at 33 right now, so it's went up a little bit over the last month. Yeah, it's up about 7% last month. I've been looking at CP. Yeah, man, CP. You cannot go wrong with it. A lot of big name investors hold this in their portfolio. Let me show you here. So we got Chris Huhn, John, Bill Ackman. Big names. Chris Huhn is a fantastic investor. Love this cat. And he's got a great portfolio. 15% in Canadian Pacific. John, yet again, really like how his portfolio is set up. Really strong investments. Kansas CP is his biggest holding. And Bill Ackman, we all know Bill Ackman. Right there again. Kansas Pacific Railway. Hanging up over 10% in his portfolio. So, I mean, it's a great company. Let's see how it's done with the drip calculator. Yeah, right in line with the market. It's actually beating the market, but if dividends reinvested, the market's beating it. But again, I like the company. I think they're going to do great long term. It's definitely one I'm looking at. 40% of my Roth's SCHD. Cannot go wrong with that whatsoever. About 40% of my normal portfolio is SCHD. Just that snowball. You gotta love it. You gotta love that dividend snowball effect. Getting those dividends, reinvest those dividends, getting more dividends. It's good. Too good. Yeah, I'm thinking about jumping into some CP myself. Another company. Oh, I'm so sorry. I'm just so sore and everything hurts. That I really like is MSCI. This was one I kind of swing traded it. I got in 470, and I sold out near the top at 540. But this is one I would have liked to jump back in when it dropped back in March 2 months ago, but I didn't. It's their leverage. The leverage kind of spooks me out of it. You're going for higher dividend yield. Okay. Do you have any cover call ETFs in your portfolio? Yeah, my time frame is 14 to 19 years. That is what I am looking at. But I mean, definitely, if you're, you got a lower time horizon, some cover call ETFs might not be a terrible idea. I know one that I've been seeing pop up a whole lot. It's called SPIY. I mean SPYI. There we go. This came out relatively new, August 2022. And I mean, since then it's only down 2%, 2.6%, which isn't that terrible. Year to date, up 3.9. It pays a really nice dividend. Very consistent across the board. Had JP but sold out. Yeah. I've got about 12 years. You got about 12 years on your... Okay. So the thing I like about SPYI over JEPI is I think SPYI is tax efficient. Let's see here. Tax efficient income. Seeks to provide higher income through call options. So a thing with them is a portion of their stuff is considered long term. And that means it's going to be taxed at a lower rate than just straight ordinary income, which I like. I mean, if this is around whenever I'm close to retirement, I'm absolutely going to start looking at this. This is going to be something that's in the back of my mind at all times, because it's not went up, down, all around. It's just kind of been flat-ish. It's hovered between $50 and $45. And a lot of your cover call ETFs are so volatile. It's kind of spooky. But yeah, I mean, that's one I like. You like bigger investments. Let's see here. You already said Enbridge. Enbridge is a great one. Do you have any EPD in your portfolio? I mean, if you're looking for dividend now, want to try and get that yield up, I feel EPD is a great one as well. I'm not worried about oh, okay, yeah. Yeah, that's a benefit of a Roth. It's such a big benefit of having a Roth IRA set up. Is, you wait till you're 59 and a half, you pull that money tax free. So good, too good. The best. But honestly, this and Enbridge has been what I've been looking at as well. My portfolio is super condensed. There's a part of me that wants more holdings. There's a part of me that wants less holdings. I'm just torn, really, about what I need to do going forward. I don't know. This is what we're rocking with right now, though. We got about, I think it's a little over $5,800 invested. Got Maine, Enbridge, and O. Were you buying really income when it dipped below 50? Because that was ridiculously cheap for that company. But those are three great income generators right there. Absolutely. My big income generator right now is Extra Space Storage. This was a scary one. This was a gut check for me. I got in, I think around here. Yeah. This is around one of the worst times to invest in it. I think it was around June, July, and I rolled this thing all the way down to $100. I was just like, what am I doing? I'm down 26% on it. And I just kept telling myself, they just did Acquisition Life Storage. They're the biggest storage units by unit size in the United States. Things are going to turn around. And boy, did they ever turn around. Revenue's going up. Let's just take a look here. Yeah, Extra Space Storage was a gut check for me. I didn't sell out. I wasn't afraid. And I have rode this thing back up. Let's see when the bottom was. 103.08. I was setting over 26% loss. Up 34.58% in the last 2 months. A month and a half, really. I got $600 when it was. That's what's up, man. That's a great entry point for a Realty Income. And it is beloved by all. Pretty much everyone that's anyone that they love that company. Even though I'm still like early in my investing, I won't call it career, but investing plan, I've been thinking about trying the whole go higher yield. And I know a lot of people would advise against that, but the more and more I watch of The Dividend Bull, I'm just like, man, that dude's got it figured out. He knows what he's doing. Love his stuff. Really love his stuff. Let's see what else news article wise I got here. 3 growth stocks primed for a 2024 breakout. What do we got here? Apple. What? I mean, I still hold it. Use 61 cost basis on your Realty Income. Dropped it to 55. Pretty good. My Extra Space Storage and Hershey were both pretty high. I got into Extra Space Storage at I think it was 140 area. Hershey, I got into 220s. I've now got my Hershey down to 214, or it might be a little bit lower. And Extra Space Storage is down into the low 130s. Have 40 shares of O now. Hey, that's pretty good. That's some pretty good income generation right there. And that's monthly. You just get to roll with that. That's pretty great. What do they pay a month? Just curious. Also, welcome everybody that's in here. I appreciate you all for dropping in. I feel terrible today. I had surgery yesterday. So if I sound a little funny, that's why. I had 2 teeth. I had to have them surgically removed. But I still wanted to jump on here and live stream talk with yins. Yeah, that's 26 cents a share. DCA for the win. Absolutely. I mean, that's $10. It's $10, 40 cents a month. It's just going straight back into it and just making it more and more and more and more going forward. That's very great. I would, again, just like, I've been leaning more and more toward higher yield investing. Like, I don't own any O. I don't own any EPD, Enbridge. These have been things that have been catching my eye because it's higher yield. But I know you don't invest in yield just for yield. But with the snowball and the compounding effect, these things have done pretty well. And another one is Philip Morris. I like that as well. I know a lot of people prefer Altria Group, but like, I think Philip Morris has a bigger grasp on the vape market than Altria does. Altria has had a lot of dart throws and misses with their investments, and I feel like they've wasted a lot. They have wasted a lot of money, a concerning amount. But yeah, I've been looking into bigger dividend, higher dividend companies. But yeah, Philip Morris. I know BTI is another very popular one, but they just, they had a big write down. Let's see here. Yeah, $31 billion write down. That's gotta hurt. That's gotta hurt. But a lot of people are looking at this as an opportunity when it comes to BTI. I have SCHD for Safe Foundation. Yeah. I mean, it's kind of what I got too, in a way. Like, it's excuse me. Welcome everybody. I see there's 5 in here. I appreciate you for coming in, just chit chatting and stuff. That's kind of what I've got going on too. SCHD is my core, and then I've got some individual positions that are kind of like my satellites built around it. But I've been, like I said, I've been leaning a little bit more toward getting some higher yield investments going, and getting that dividend income in and reinvesting it and getting that snowball going even quicker. Because like Apple, yeah, you're gonna get a lot of growth, but like they don't really do much for their dividend. It hasn't been a focus for them forever. Right at 5% growth over the last 5 years. But I mean, the thing with them is they do a lot of buybacks. So I mean, that is a good thing. And I do think that Apple's going to go back to their big growth stream once they open things up there in India. I know that's somewhere they're trying to expand very heavily in. I definitely see them turning things around. I don't think they're going to maintain the number 1 position in market cap. Microsoft's just on such a tear. Such a tear. They are just destroying everyone. In a good way, though. But yeah, I've been taking a hard look at my portfolio more and more. I'm just kind of uncertain what I want to do with it. Oh yeah, I mean definitely. Higher yield give your snowball a shot in the arm. Absolutely. I mean there are a lot of high yield investments that like over time have beaten or done right in line with the S&P 500. Let's see here. Let's take a look at Altria from 2000 to today. Let's look at that. I mean, this is right at the beginning of 2000. SP 500 setting right at 7% dividend annual growth. Altria 15.21. Let's see what Main is. Just put in a couple of bigger investments here. Main 16%. Still got some really nice growth going on. I mean, you could do this all day and see very similar results. Ares Capital Corporation's another one that's very popular in the high yield community. ARCC. Yeah, this is I think this is another BDC, isn't it? Yeah, right at a little bit over 9%. I know this is another popular one that the Dividend Bull likes a lot, because of their dividend. Curious what they recommend here. Oh yeah, Energy Transfer. That's another one that's been kind of piquing my interest-ish because it's them and EBD, EPD are your two big what am I looking for? LPs when it comes to like your pipeline stuff. The thing with them though is they do have that decrease in dividend. It's a little scary, and they had a period there where they didn't really bump it up any. Let's see. Are they increasing their dividend quarter over quarter? It looked like it was for a minute. Yeah, last year that's exactly what they were doing. So if your company's able to do that, that's pretty good. But yeah, EPD's been one on my radar. There was another company I found that's been increasing its dividend quarter over quarter. Was it Microchip? Yeah, this one. I don't know, like if you're able to just do this, increase your dividend quarter over quarter, that just tells me you got so much money you don't know what to do with it. And they've started buying back shares and stuff. This has been another one that I've just keeping my eye on because it's interesting. I think it's just silly when a company's able to do that. Okay. Boop. Boop. Alright guys, you guys are going to have chair cam for just a second. I'll be right back. Again, appreciate everybody in here. Don't go anywhere, I'll be right back. Be right back. Alright guys, we're back. We're back. Sorry about that. We are back. We are back. We are back. Oof. A little bit of chair cam action there. But yeah, going forward, I got a lot of thinking to do with the portfolio. I don't know exactly what I'm wanting to do. Again, it's one of those, like, I feel like less is more. Because I do like being as concentrated as I am, but, like, anyway, I don't know if I want to sell out of some of these and go into, like, another ETF. Maybe split it, go into a growth ETF and just something like VU. And let it compound with my SCHD holding. I got a lot to figure out. I got a whole lot to figure out with this. So what are y'all's plans and stuff for today? What you got going on? Probably gonna chill, sit around, watch little YouTubes, play some good old video games. Probably do another live stream tomorrow. I like doing these because like I do like chit chatting, talking stocks with friends, just hanging out, looking up random stuff here and there. You got 30 shares of VU. Yeah, I'm wanting to. I've been leaning more and more toward ETF investing. I mean, it's not like I'm not beating the market. I beat the market by 6.5 last year. I'm beating the market by about 6% this year. But it's a lot of work. But like I don't mind it. I like looking at individual investments and stuff. Again, I'm so indecisive. I don't know. I don't know what to do. I will say a bone if you haven't. I've got some my last couple uploads. If you want to check those out after the stream, drop them a like. I'd greatly appreciate it. Definitely with YouTube, trying to get my watch time up is a big thing. We are a little bit over halfway to the requirement to apply for monetization. That's the big thing. Being able to make those ad dollars. And streaming and stuff does help. It's the reason I do appreciate everyone that drops in, hangs out, says hi. This helps a lot. And just watching those videos all the way through, liking them up, helps a lot. It really does. It helps a ton. And I do greatly appreciate everybody. But yeah, going forward, I'm not 100% sure what to do, what I'm going to be doing. I got to break everything down. All I know is the ones that I do hold, everything I do hold, I know pretty much in and out, up and down. They're very reliable growers. They're great dividend growers, great compounders. Most of these are double-digit growth as a whole. I know MasterCard's market beating, Texas Roadhouse is market beating, Extra Space Storage has been market beating, CNI has been safe and defensive, Hershey is safe to defensive, and Apple's been extremely market beating. But yeah, I like the portfolio. It's just, again, I don't know if I want to simplify it even further or what I want to do. A lot of thinks and thoughts to look into, and just everything as a whole. Oof. But yeah, I think I'm gonna go ahead and go. It's been about an hour. Again, I'm gonna do another live stream in the morning, probably around 9:30 Central Standard Time. So make sure to drop back by then. We can hang out some more, look up some stocks, talk some stocks. Appreciate you hanging out with me, Bones. I just heard a lot. But yeah, make sure to go my portfolio. I'm at my channel. Check out some of my most recent uploads. I greatly appreciate it. And yeah, I hope everyone has a fantastic day. Thank you for coming by, and I will see you later.